Welcome to Financial Insights in Minutes, where we dive into the turmoil shaking global markets caused by plummeting interest rates.
Indeed, we'll hear from expert Jeff Snider, who predicts unsettling market shifts due to Federal Reserve policies.
Also, we'll summarize Lobo Tigre's urgent warnings about recession signals and how they might impact your investments.
Prepare for potential aggressive rate cuts as we analyze key signals indicative of a faltering economy. Stay tuned.
Our AI-generated summaries capture crucial insights from leading analysts, allowing you to stay ahead without missing a beat.
Exactly. Designed for efficiency, our framework distills expert analysis into easily digestible takeaways.
So, join us as we navigate through collapsing interest rates, evolving market strategies, and critical economic warnings. Let's navigate through the turbulent waters of global markets. Today's hot topic: interest rates collapsing and the panic it's causing across the financial spectrum.
Absolutely. Jeff Snider breaks down the alarming trend of the 2-year U.S. Treasury yields dipping below the Federal Reserve's target rates at an unprecedented level. Buckle up for intense financial analysis.
So what's the crux of Jeff Snider's findings? Why are markets in a state of panic?
The core thesis revolves around the rapid decline in short-term interest rates, specifically the 2-year Treasury yield, which now stands at just 3.61%. This record low suggests that the Federal Reserve may need to cut rates significantly due to underlying economic weakness.
Let's dive into the key points. First off, what about that interest rate disparity?
Right. The 2-year Treasury yield falling so far below the Federal Reserve's rate targets isn't merely a blip, it's the largest gap on record. It paints a bleak picture concerning future interest rate strategies.
And what about commodities? How are they shaping this narrative?
Crucial. Oil prices have plummeted by over 20%, and gasoline prices are also down, indicating that demand is faltering. This signals economic distress, a warning flare indeed.
So this isn't just a U.S. issue, right? What does the global stage tell us?
Exactly. Weakness is being observed worldwide. Currencies like the Japanese yen are under pressure, highlighting a synchronized economic challenge across the globe.
Let's ponder some predictions. What's on the horizon regarding rate cuts?
Insiders predict aggressive rate cuts. Multiple adjustments could be necessary as the Federal Reserve reacts to mounting pressures from both market and economic data.
And what about the timeline for this economic slowdown?
Jeff highlights that we could be heading toward a significant slowdown over the summer months, echoing patterns observed in previous recessions.
To wrap it all up, what are the big takeaways from Jeff's analysis?
The ongoing plunge in interest rates signals that the Federal Reserve can no longer ignore market realities. A strategic pivot is essential to navigate this troubling economic landscape.
What are your thoughts on how the Fed should respond?
Proactive measures are crucial as we observe these economic signals. The Fed faces the challenge of not just reacting, but setting a strategic course to stabilize the markets.
As we finalize this session, let's hear from you. What do you think will unfold in these challenging economic times?
Your insights can spark essential discussions about where our economy is headed, so don't hold back.
Navigating the tumultuous economic waters, we dive straight into Lobo Tigre's urgent warning that flashing red signs loom over our economy. Buckle up as we explore shifting sands in markets and what these signals could mean for precious and base metals.
True. Lobo's insights are always compelling, and today he's drawing from vast experience analyzing commodities and the complex interplay of economy and elections. Let's dig into the numbers and predictions that will leave you questioning the well-being of your investments.
So, what's the crux of Lobo's message? Why does he believe we're headed towards darker economic waters?
Lobo asserts that while statements from figures like Janet Yellen may paint a rosy picture, the reality is much grimmer. Indicators pointing towards a recession are everywhere, from labor market alerts to commodity price drops, making it hard to ignore the storm brewing ahead.
Let's break down the key points, starting with the labor market. Lobo mentions significant cracks are showing, correct?
Exactly. Job openings are at an all-time low, coupled with rising layoffs. Definitely a sign of trouble. It's akin to looking through a cracked lens. The numbers may seem okay at first glance, but the reality is much worse.
What about commodities? Are they also providing stark warnings?
Absolutely. Copper and oil prices are emitting recession signals loud and clear. These indicators are historically reliable, and seeing them dip should raise red flags for every investor out there.
Now, Lobo hints at political gamesmanship and economic commentary. What's that all about?
Policymakers might sugarcoat grim realities ahead of elections. This disconnect can mislead the public regarding the real economic landscape, ultimately impacting their financial decisions.
And how do elections factor into this?
Election promises often lead to increased spending without addressing inflation. Candidates vying for votes tend to propose grand policies, but these strategies can exacerbate economic issues rather than resolve them.
So, what does Lobo foresee for the economy? Any specific predictions?
He foresees a hard economic landing soon, with many predicting adverse factors in the labor market and consumer spending could coalesce into a full-blown recession. The data indeed suggests the worst is yet to come.
Any predictions for commodities?
Lobo suggests that commodity prices will continue to face volatility. Investors should brace for unpredictable shifts as recession fears loom.
Finally, how should investors interpret Lobo's insights?
It's clear, caution is paramount as signals point to potential downturns. Investors must act prudently and stay informed to navigate future economic turbulence.
What should viewers focus on in light of these predictions?
Stay vigilant and flexible. Monitoring market signals closely can lead to opportunities. This tumultuous journey may yield valuable insights on where to invest next.
And as we draw this discussion towards a close, we'd love to hear from you. How do you plan to navigate this shifting economic landscape?
Let us know in the comments. Your input can help shape the conversation on strategies to adopt amid these turbulent times.
Now, let's dive right into today's CPI report. Is inflation cooling, or are we just feeling the heat of the unknown? With markets on edge, it's time to navigate through these turbulent waters.
Right. This CPI release is one of those market movers that can shape investor sentiment. With Matt's keen eye and analytical prowess, we're sure to dissect the implications and forecast what could come next.
So what's the core thesis we need to focus on today?
The core CPI figures reveal critical insights into inflation trends. The report showed a month-over-month increase of 0.2% on the core and 2.5% year-over-year, which leaves investors questioning the Federal Reserve's next moves.
Let's break down those core CPI details. What are the significant takeaways?
Well, the core CPI rose by 0.2% month-over-month, but the year-over-year figure remains steady at 3.2%. This is raising eyebrows about potential Federal Reserve rate cuts.
And how is the market reacting to this news?
The Dow futures are dipping about 25 points, showcasing just how jittery traders are in response to such pivotal information. The reaction will likely develop rapidly.
What does this mean for the Federal Reserve and their policies?
If inflation continues to show strength, we might not see the 50 basis point cut traders hope for. There's still a solid discourse about 25 basis points, though.
Now let's gaze into the crystal ball. What are we predicting with inflation trends?
With inflation holding strong, experts predict we might have to brace for a long road ahead before we see meaningful discounts.
What's in store for market volatility going forward?
We can expect to see heightened volatility. Markets will react sharply to any Federal Reserve adjustments in the coming weeks.
In wrapping it all up, what should traders take away from today's summary?
The CPI results are pivotal. They reflect ongoing inflation concerns that will influence Federal Reserve decisions. Traders should stay alert for updates.
As we conclude this summary, what's your final thought for our viewers?
It's crucial for traders to maintain their wits. With varying signals and market pressures, staying informed is more important than ever.
Before we move on, here's a tease for what's next. Our in-depth discussion on trading strategies based on today's insights.
You won't want to miss it. Stick around as we explore actionable insights.
Let's dive right in. The market, as Tom puts it, is gearing up for an intense few months. UBS has dropped some startling predictions that might just make your jaw drop.
Absolutely. The volatility spike foreseen as we head into November could shake investors to their core. Let's navigate these turbulent waters as we unpack the charts and data.
So, what's the main thesis here? What's got UBS on high alert?
UBS projects that we could see a 10% decline in the Russell 2000 alongside significant moves in high-yield bonds. This is largely due to rising volatility, especially as we're approaching critical election periods.
What's the scoop on upcoming volatility?
Tom highlights historical trends showing that volatility often peaks in election years, particularly leading to market lows in August and October, potentially setting the stage for a rocky ride.
Let's talk about UBS's perspective. What are they projecting?
They foresee a worrying 10% drop for the Russell 2000 and express caution over high-yield bonds as we face deeper market scrutiny triggered by recent volatility.
What broader economic signals should we look for?
The analysts are drawing parallels to the inflation dramas of the 1970s. Traders are bracing for potential downturns as we're seeing signs of late-cycle economic behavior.
Time for predictions. What should traders anticipate?
Expect a market correction as the undercurrents of bearish sentiment grow stronger. The shifting dynamics make it very likely that this trend could last well into the end of the year.
What about further into the future?
Volatility isn't going anywhere. As we move into 2024, traders should gear up for an environment that could remain fraught with uncertainty, fueled by upcoming economic events.
Wrapping things up, what's the crucial takeaway?
Stay alert. With UBS anticipating a significant downturn and volatility set to rise, understanding market signals will be paramount for navigating the choppy waters ahead.
As we close out, one final question. How are traders preparing for these anticipated market shifts?
That's the million-dollar question. We expect traders to strategize for maximum resilience and adaptability as the market dynamics shift. We must keep our eyes peeled.
In this insightful interview hosted by Ted Oakley with the extraordinary Dr. Lacy Hunt, expectations for the U.S. and global economy come under scrutiny.
The conversation kicks off with Lacy's firm take on the dismal prospects for economic growth, shedding light on the fiscal and monetary policies governing our future.
What is the central thesis of Dr. Hunt's message?
The core thesis reveals that both the U.S. and global economies face critical challenges. Poor fiscal and monetary policies coupled with demographic issues set a grim stage for future growth.
Let's delve into those key highlights. What about negative national saving?
Exactly. The U.S. is grappling with negative net national savings, insufficient for physical investment, echoing the economic stresses felt during the Great Depression.
And how about the monetary policy challenges Dr. Hunt highlights?
Monetary policy is currently under siege. There's been a significant contraction in the money supply, and inflation overshadows signs of recovery at every turn.
Let's look at demographic trends discussed. What's the take?
Demographics are against us. The average age in the U.S. is climbing, and as birth rates dwindle in major economies, we face a bleak future with lowered demand.
Let's venture into Dr. Hunt's predictions. What shall we expect on the inflation front?
A concerning spike in inflation could hit hard, effectively leading us into a phase of economic stagnation, impacting consumers right where it hurts: their pockets.
And regarding investments, what foresight does Dr. Hunt share?
Investors must brace for a paradigm shift. A higher inflation environment will necessitate significant adaptations in their investment strategies.
As we sum up Dr. Hunt's insights, what are the overarching takeaways?
The crux suggests that our policymakers must shift gears for sustainable growth. A recalibration is essential to tackle the economic issues we face now and in the immediate future.
Finally, what are your thoughts? In which direction do you believe the economy will head?
We would truly love to hear your opinions. The economic landscape continues to shift beneath our feet. Stay tuned for more updates.
What a fascinating discussion. We've gained so much insight today about the economic signals and pressures through the perspectives of our guests.
Absolutely. Jeff Snider and Lobo Tiggre both present compelling cases for vigilance regarding economic downturns.
And let's not forget the contrasting views on approaches to navigate this volatility. Matt warns against aggressive trading, while Tom advocates for flexibility in strategy.
Such rich insights. It's clear that understanding these dynamics is essential for making informed investment decisions.
If you found value in today's discussion, please like and subscribe to our channel. Your support helps us bring you more timely financial insights.
And don't forget to watch our other content. There's always more to explore in the world of finance. and we want you to be well informed.